For the period end financial audit focus today, we are going to discuss capital expenditures and pre-opening expenses. The period end financial close process allows full visibility into where the numbers presented on the financial statements are coming from in order to provide trust and security in knowing that the information is accurate. Each close should focus on a review of the financial statements with focus on identifying any areas of opportunity. Pay special attention to areas where increased awareness and accuracy and timeliness could improve the integrity of the financial information. Lastly, post-review, you want to establish where developmental opportunities lie, especially with the capital expenditures and pre-opening expenses, where they create the financial worth of your business. It is important to verify that your team is armed with education and resources to correctly record, audit, and understand the restaurant's financial results. Let's begin with capital expenditures. Capital expenditures reflect the value of what you have put into your restaurant. These are tangible expenses that can be depreciated over time and adjusted on your year-end tax return by your CPA. This can include large purchases for items such as building improvements, signage, cooking equipment, and POS equipment. The threshold of what is considered a large purchase is dependent on sales volume and should be discussed with your CPA prior to coding. So what could cause your capital account to go out of balance? The main cause is when expenses are coded to the asset accounts instead of the expense accounts. We all know it hurts to put that $800 repair expense on the P&L, but if it doesn't hit the threshold, taking the expense now will better reflect the restaurant's true cash position than trying to depreciate it over time. Take time when answering bank reconciliations as well to ensure that proper expenses are coded to the proper accounts. If the account is out of balance, first determine what the balance should be. If it is overstated, meaning that it reflects more of a balance than what you own, review the balance sheet trial balance for any items that should be expensed to the P&L. Specifically, look for small balances coded to the capital account. Once you identify the incorrect balances, let your accountant know where they should be adjusted to. If the capital account is understated or less than what you own, you will review the P&L trial balance with an eye instead on large expenses coded to the expense account that should have gone to the capital account. Communicate any needed adjustments to your accountant and always consider if any use tax implications may apply. When it comes to best practices, the key is to review and audit on a frequent basis. The quicker you catch it, the easier it is to resolve. Review the balance sheet, identify where you want to dive deeper, and audit the trial balance. Refer any questions on what should be considered a capital expenditure to your accountant prior to allocating the expense. Now let's talk about non-tangible assets, such as pre-opening expenses. This could be any items that are amortized across time, such as opening, training, and labor expenses, food preparation, and testing and utilities. The balance in pre-opening expenses starts to build what the long-term return and show the true value of the business for investors. The most common cause of inaccurate pre-opening expenses is when items that were expensed prior to the first day of sales are coded to expense accounts instead of to pre-opening expenses, or when expenses are recorded as pre-opening expenses, even though they take place after the restaurant's doors are open. Keep in mind that pre-opening expenses are only for expenses that occur between the startup of the business and the first day of true sales. If the pre-opening expenses are overstated or more than what you own, start by reviewing the balance sheet trial balance to determine any incorrect activity. Research any activity posted after the first day of sales and communicate any expenses that need to be moved to the profit and loss statement to your accountant. If they are understated or less than what you own, research any activity on the P&L trial balance prior to the start date and determine if any of those expenses should be moved to pre-opening. Communicate any adjustments to your accountant to reduce the loss on the P&L and increase the asset on the balance sheet. Just like capital expenditures, the pre-opening expenses GL should be reviewed on a frequent basis, especially during the initial startup of the business. But even after, it is important to verify the balance to ensure no items were accidentally miscoded to this GL. As you record your startup expenses, lean on your accountant for questions on what is a pre-opening versus legal expenses to ensure that all expenses are distributed accurately. Keeping an eye on these accounts will allow you full visibility into the worth of your business and keep your financials clean. Always remember to communicate adjustments and ask questions if you are unsure. Complete the bank reconciliation prior to conducting your period end financial close to ensure that you aren't causing additional adjustments. And most importantly, communicate results and areas of strength and opportunities to your team. The financial success of the whole team is predicated on the knowledge, accuracy, and timeliness of each individual. Thank you for your time, and don't forget to visit RASI USA for additional resources, tips, and more information. Have a great day.